future. We're talking real money.
You know, I just realized today that I have now passed 35 years of doing a money talk show of some kind. 35 years. But I'm not that old. I don't know how it's possible. Hi, everybody. Don McDonald here. And if you had hoped to spend a little time with just me, well, your wish has been granted for about an hour because Tom is at his daughter's soccer game. So I'm here with you, and I would love to talk to you about, well, money stuff at 855-935-TALK, 855-935-8255. So call right now. We've got all the lines open. Anything pretty much goes as long as it's money oriented, although the bulk of what we talk about involves investing for a number of reasons. One, investing is one of the few ways you can get to where you want to be in the future financially on your own without just dumb luck happening. So, I mean, you can build a business or you can invest. You save, you invest, you build a business, whatever it might be, but there aren't very many ways to get to a more financially secure, slightly wealthier future. So that's why. The other thing is this industry is so confusing, it is so convoluted, and in many respects, it is so crooked, as in twisted. Not illegal crooked, but crooked as in twisted. Crooked as in not doing the right thing for the people whose money it is. And so this is why we talk so much about money, because there's just so much bad information out there. There is just horrible advice out there. And there are so few ways for you to protect yourself against those things that we have to have a show like this. And there aren't many like this. Oh, I know there are a lot of money shows. There are tons. They're legion. And we're going to talk about some of those we have in the past, and we're going to talk about one in particular in the not too distant future. However, they're not looking out for you. They are there entirely to sell something to you. And usually that something they're trying to sell to you is a product that we discuss almost ad nauseum here on the show. And those are these indexed annuities, these fixed indexed annuities that are so easy to sell because they sound perfect in so many ways. You get the returns of the market with none of the risk. Yay, that's wonderful. If there was such a product, wouldn't we be telling you about it? Particularly if it could make us... We haven't done anywhere near this. We are in the wrong business, Tom and I. Between 2014 and 2022, a duly registered investment advisor by the name of Jeffrey Cutter. He's both a registered investment advisor and an insurance salesperson. He made $9 million in commissions selling 580 fixed indexed annuity contracts. 580 customers, $9 million. Do you see why people sell these? Well, because he's a registered investment advisor, the SEC, the Securities and Exchange Commission, which regulates registered investment advisors, is trying to sue him for doing wrong by his clients, for not meeting the fiduciary standard. However, most who follow this case are concerned that the SEC is going to lose because fixed indexed annuities have a loophole that Congress gave the insurance industry after 9 figures of lobbying. They gave them an exemption from regulation by the SEC. The SEC wanted to regulate fixed indexed annuities, and the government, the Congress said, no. We should let the state insurance commissioners do that, which I got to tell you, the state insurance commissioners are horrible regulators, because they let insurance agents get away with incredibly misleading information. And we're going to follow this because I want this guy to go down. I don't think he will, but boy, I wish he would. Be right back.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Cutter Financial Group being accused by the SEC of failing to disclose commissions and churning annuities. This is a duly registered firm. The company is a registered investment advisor and an insurance agency, and they sold a lot of fixed indexed annuities to people, got $9 million in commissions from 580 clients, or with 580 contracts. And there are people out there arguing that these are good things, that they shouldn't be regulated. Let me just give you one quote from a lawyer. He says that the SEC has for decades been trying to get jurisdiction over these insurance products and has passed rules that have been struck down and has sought congressional authority and been unsuccessful. He says if they're successful, investors will have fewer choices when it comes to engaging in purchases of these products. That's the whole point. Does this guy actually believe that not disclosing commissions is the right thing to do? Even if these are great products, the commissions should absolutely be disclosed, and they are uniformly not disclosed. And by the way, the lawyer who commented, he works for he says he co-founded a nonprofit called Investor Choice Advocates Network. So it sounds like he's just looking out for investors. Well, he is an attorney, and the advocacy network that he has, I checked their 990, and they've got $54,000 in contributions, and they haven't spent pretty much any money on anything. They just have some money with which they started a nonprofit to make them look less tainted, in my opinion. I betcha the lawyer and the law firm work for insurance companies. I don't know, but I betcha. 855-935-TALK is our phone number, 855-935-8255. We had people on the line. Give me a call back. And they went away. I don't know what happened. The phones went weird or something. 855-935-8255. And this kind of stuff is why we get in trouble with insurance guys all the time, insurance guys and gals. We've been yelled at recently on the show because the supposedly we're lying about these. We're not lying at all. Everything we have told you about indexed annuities is the God's honest truth, and all you have to do is look up EIAs or indexed annuities online and read news. Read actual news from news sources, and you will discover that they are almost universally minimally disliked or hated because of the lack of clarity and transparency that is associated with the sale of a product like this. Plus, this is where I want you to just bear with me for a minute. Think about all of these kinds of products logically for a moment. Just be logical. Turn off your emotions. Turn off the little wish glands. Oh, I wish I could find this. You can't. There cannot be. It is literally impossible for there to be any type of investment product that can give you the return of a particular market with absolutely no risk. They can give you a return based on a particular market with lower risk, but even the no risk argument with me doesn't hold water. And let me explain why what they are telling you is a lie. And we've done this before. I've written articles on indexed annuities, but they are still the hottest product in the insurance investment industry. They are sold like crazy. They are designed specifically to be confusing. It is called baffling you with BS. There is too much for any normal human being to go through and understand when trying to suss out the problem with these products. One, they promise you the return of an index. Now, you'll read articles and they'll say an index like the S&P 500. No. Very few are based on the S&P 500. They're based on indexes created specifically for the use in these kinds of products. In other words, indexes that give the advantage to the insurance company. And how does the insurance company make money with these index products? Well, the liars in the industry will say, well, there are no fees. Well, okay, you're not being totally honest. The insurance company has to make money on a product like this. Now, if they're giving you the full return of the stock market and there's no downside, they will lose money. Not only will they lose money, they will lose a lot of money. No insurance company that I'm aware of was created specifically to lose money. That would be a bad business model. So how these things work is they take a very esoteric index. They give you just they calculate the return, the rise in that particular index. Then they give you a portion of that particular index. And again, remember, they're trying to find an index that hasn't been as good to investors as others. And then they will give you a portion of that index. That's how it's based on it, up to a cap. Because, well, if that index goes up 99% in a year, they don't want to give you 85% of 99%. They don't want to give you that much money. They can't afford it. They'll go broke. So they put a cap on it too. And that means that the average annual returns are going to be right around the rate of safe money. In other words, these products are merely a replacement for the insurance company for the dull, boring fixed annuities, which was the bread and butter of the industry for most of its life. Just, we'll give you 3-4% per year, 5% per year, 6% maybe, because then we can take a little bit of risk with the money you're giving us, and that's how we make our profits. But when people realized that they could take the risks themselves, the insurance company had to have something to respond to that. And what they did was they said, well, what do people want? They want to make a lot of money and they want no risk. Those are the two things they want. How can we give them the appearance of that? This is how these products were invented, to give the appearance of something that is literally impossible to provide. So you, since the government can't step in and protect you because the government refuses to, your congresspeople refuse to protect you from these things. Why? Probably because the insurance companies give them millions of dollars, hundreds of millions of dollars over years. So who else is going to look out for you? We can't do it. Although you can certainly call me and I will try. 855-935-TALK. No, the only one who can do that, who can actually help keep you from getting into products that will disappoint you. They will disappoint you. And you will generally be locked in for 8, 10, 12 years. The only one who's going to protect you from those is you. So if it sounds too good to be true, it's too good to be true. Trust me, it is.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Our phone number again, 855-935-TALK. Our phone number, yours and mine, and even Tom's when he gets back. But he's at a soccer game right now. So give me a call. We've got all the lines open because some folks dropped off, and I really would love to spend some time with you. 855-935-8255. And I am really hoping, I don't think it'll happen, and then there's the appeals process. I really am hoping that the SEC does win this, because if someone is a registered investor, this is where I hate the system. If you are a registered investment advisor required to act as a fiduciary, you shouldn't have a loophole that allows you to kind of sneak out from under that hat and sell stuff that's bad for people, that's misleading, that's not disclosed, that for which disclosure is not even required. You shouldn't be able to do that. That's just wrong, because the registered advisor designation is supposed to mean something, and it means nothing if people can be duly registered, which legally right now they can, which is a pity. But the industry doesn't want to change, because actually working in your best interests won't make you as much money. I'm pretty sure, no, I know for a fact that in the, let's see, Tom and I started this company like in 2009. So what is that? Like 12, 13, 14 years. No, we didn't make $9 million, and we have a lot more than 580 clients. This is not the way to get rich. That way is 855-935-TALK, 855-935-8255. Give me a call live, or we even take calls when you call in and leave them like this.
Good morning. This is Ken in New Orleans. Question is, I own BND bond funds from Vanguard, and it keeps going down in value, and I don't understand. I wish you would explain, why does it keep going down in value, but y'all talk about earning or owning it, and would you please give me a little hint as to how it works and why it's doing what I do and I should hold it? Thank you.
Well, Ken, it's a little confusing, particularly for someone who is used to a bank account where, or a CD where the value doesn't fluctuate. You just get income, and then when it matures, you get your money out. Or in a bank savings account, you get your income, and then you get your money when you want it. Bond funds buy individual bonds, and the way bonds work is that their market value, which is what the fund has to express all the time, their market value fluctuates depending on the direction that interest rates have taken or are expected to take. So if interest rates are rising or are expected to rise, have risen or are expected to rise, the value of the underlying bonds in the portfolio, the ones they already own, will go down and have gone down. However, as those bond values are going down, the interest the fund receives has risen. So over the past 5 years or so, BND, the Vanguard Total Bond Market ETF, has dropped from about $88 a share to as low as about $71 a share. This year, it's fluctuated just in the low 70s. So it hasn't, the big drop happened between 2020 and 2023. That was a huge drop as rates rose. Rates have fluctuated in the last year. They've gone up, they've gone down, they've gone up, they've gone down. But while the value of your fund may have gone down this year, your income has been steadily rising, which means you're not at a loss this year when you calculate the income in, but they do tend to have some degree of volatility.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey there, Don McDonald here. Tom is at his daughter's soccer game. He's planning to sneak back in here before the show's over. I'd love to hear from you if you have a question about money, because this is a show that's supposed to make money easier to deal with. That's our goal, to shift the odds in your favor. But you have to call, or I don't know what to help you with. 855-935-TALK is the phone number. We have lines open for you right this very moment. You can also call that number and leave your questions on the answering service, such as it is. And here's one of those right now.
Hi, this is Steve in Florida. Question for you. My wife and I are both, I'm 67. My wife is 63. We're both retired. We both have a pension from New York State teachers, and we are both taking Social Security, and we're able to live very comfortably on those four sources of income. We have roughly $145,000 in cash and emergency fund money, and vacation money and retirement money. We also have $400,000 in our IRAs. Question I have for you: at our age, since we don't need the money, and by the way, I did take the risk quiz. My risk level is 55. My wife's is 50. Is it okay and is it smart to have money in the Fidelity Total Stock Market Fund and in the Fidelity Total International Stock Market Fund, and around 40% in CDs laddered out to 5 years? That's my question. You do a lot with people growing money, but how about the people who need to spend it? And I want to know if I'm doing the correct thing. And by the way, the money that we're saving for emergencies, that's in 5 to 2 years CDs and in money market. Looking forward to hearing from you guys. Again, Steve from Florida. Thank you. Bye.
Thanks for the question. And we do try to talk about income in retirement, and you're in great shape. You're in very, very good shape. As you said, you're comfortable. You have to take that $145,000 and push that over into the portfolio, because all of your money is your portfolio. Therefore, your stock to bond ratio is closer to 40-60 than 60-40. So you're 60-40 in just your IRAs, but when you throw the cash in there, you go to 40-60, which is dead on in line with your risk tolerance. And I believe wise, because just having fixed income has proven over time not to be a very effective strategy if you want to build wealth for the future. So I think you're in just terrific shape. I think your funds are fine. I think your ladder is great as long as you can maintain the discipline of the ladder. That's one of the big tricks with ladders, is you have to maintain that discipline. You always have to go back out and reinvest at the longest maturity. But otherwise, this is a very, very good-looking portfolio, and I think you're in decent shape for the long haul. Now, if some really expensive surprises, they're usually medical or long-term care related, come along, you could drain that $500,000+ relatively quickly. So that's another reason to lean more towards trying to grow it over time, since you're not touching it. And you're still a ways off from I didn't say what kind of IRA, but you're a ways from your RMDs. And even those then can be reinvested back in the same things after you pay the taxes. So, smart. I think this is a great portfolio. It's the kind of thing I would certainly have. I would be very, very comfortable with, even given your risk quiz scores. And, I appreciate the call. You can call your questions in to 855-935-TALK, 855-935-8255, and you can record them, or you can call live like Mark. Hey, Mark, welcome to the show.
Thank you. How you doing today?
I'm good. How are you, sir?
Oh, doing well. So I've got a bit of an off question for you.
Sure.
I'm interested in crypto and close to becoming a true believer in the 4-year cycle on the Bitcoin, but I wanted to get your take and see if you have any reason or can see any flaws in the 4-year cycle, if you're familiar with that.
The 4-year, I'm sorry, you said 4-year cycle?
Yes, 4-year
Yeah.
cycle on Bitcoin.
Yeah. I'm sorry. You were kind of hard to understand. Well, let me start out by saying, Mark, Bitcoin is not an investment. An
I know
investment.
that. It's a minor part of my portfolio.
No, yeah, it's not. It's a gamble. It's just pure gambling. And if it's money you're comfortable gambling, I guess I'm okay with that because I don't want to stop anybody from gambling. But I really think if you're going to gamble your money, there are even better things to do with that. So hang on with me a minute, though. We've got to take this break. And if you can hang on, I want to talk more about cyclical timing.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
Hello, everybody. Welcome back. I'm Don. 855-935-TALK is the phone number here. 855-935-8255. Hanging on the line is Mark wanting to discuss the purported 4-year Bitcoin cycle. Let me ask you, because this is everything I've read about the 4-year cycle is sort of nebulous, and this occurs to me when I hear about this, that people are saying, well, look, we looked back and we found this 4-year cycle. Well, I've looked in the sky and I can see people's faces. Human beings we're always looking for patterns. We look for patterns. Years ago, I've been on the radio 35 years talking about money. For many years, people called and touted this thing called the Elliott wave, which was based on the Kondratiev wave, which was supposed to predict the movement of the stock market with uncanny accuracy. And it did, back-tested, it didn't going forward. It failed to work. That's the problem with most of these things. If there was anything that was consistent and worked, then everybody would be using it, and then it would no longer work anymore. And that's the reality. Now, looking at an actual chart of Bitcoin going back to 2015, and you won't find a 4-year cycle. You'll see that it peaked at $20,000 in 2017. I remember it well. Then you got a dead cat bounce in 19 where everybody thought it was roaring back, and it got up to like 12,000. Then we had the incredible run up in 21, followed by a huge decline later in 21, followed by another huge run up later in 21, followed by the decline in which we now sit today and have been sitting for a couple of years. Nothing in that suggests there is a head and shoulders pattern or any kind of tradable pattern, even though I don't believe in tradable patterns at all, which means you're going to get into something based on some really flaky theories. Make sense?
Yeah, I understand that. Like I said, I was just wondering if you had looked at it and had any flaws.
I think there are flaws all over the place. Again, and the other thing is we have no history. Bitcoin has hardly existed. We've got no history that shows trading patterns. Then the other thing, this whole business about it, the halving, when, the number of Bitcoins mined halves and then halves again and then halves again. Okay, so that's going to reduce supply. But the reality is, where's the demand side of the equation? Supply is one thing, but you've got to have actual demand. You have to have a purpose for cryptocurrencies. And I have been sitting here since 2015 saying over and over and over again, what is the purpose? Show me the purpose. Nobody's been able to show me a purpose yet.
Well, the one purpose I can see it is if you have family in another country and you transfer them Bitcoin, you don't have any transaction costs in that transfer.
Oh, yes, you do. Oh, yes, you do, though. You do. You actually do, because you got to turn it back into money. You can't spend the
on
Bitcoin.
The other end, you do.
Yeah, well, and you're in, too. To get the Bitcoin, you got to pay a fee. And then at their end, you got to pay a fee. And those fees at a retail level can be as high as 10%, which is less than Western Union or more than Western Union charges.
That's probably true.
So I've looked at maps of where you can spend Bitcoin, and I've never found a store I use. I've never found a single store I use. Not one.
Yeah.
So I think it's worth. There's a lot of hype. There's a lot of smoke. I just don't think there's any fire.
All right. Thanks for your
input. If you want to gamble, go play penny stocks, or better yet, go to the Muckleshoot Casino. I bet they'll buy you drinks.
Oh, they probably will.
Yeah. So
more.
Your crypto guys won't buy you drinks. I doubt it. I don't know. Well, good luck to you. Thanks for the call. I really appreciate it.
Thank you.
Take care. Bye-bye. 855-935-TALK is our phone number. That's 855-935-8255. And one of the arguments, crypto's just modern gold. Again, gold is at least tangible. It is, and it's semi-fungible. Bitcoin is difficult to fungigate. You have to pay a broker to do it, and then don't get me started on brokers. Do you know how many of these brokerage companies have gone under, have been either outright scams or just so horribly managed that people lost a fortune with them? It's worse than banks in the Wild West. These guys are stealing billions of dollars and getting away with it. Although Sam Bankman-Fried, he's going to go down. He's going to go down. And boy, does he deserve to. So, I'm going to argue against gold. In fact, we're going to talk about gold and the perceived safety thereof. But as much as I'm against gold as an investment, I am almost infinitely more opposed to crypto as an investment. Because it is nothing. It is literally nothing but an idea. It's whatever you imagine it might be. And if it was just Bitcoin, okay, there might be maybe 1,000,000 to 1 shot. It has some sort of a future. But crypto is not just Bitcoin. Crypto is outright jokes, humor, satire that people have actually given true value. They have taken a joke and given it value. And I'm speaking of Dogecoin. Now, you have to think that somebody like Elon Musk was just sitting around going, let's see if I can mess with my followers and get them to buy a bunch of Dogecoin and make me even richer. And guess what? You fell for it. Some of you fell for it. So the old P.T. Barnum saying about there's a sucker born every minute. There is a sucker born every minute. You can fool all of the people some of the time, or some of the people all of the time, or I don't know how many times you can fool them. But Bitcoin is just proof. And, Dogecoin is absolute, unadulterated proof that people, when it comes to investing, just aren't particularly bright. We suspend disbelief and just will buy into almost any wacky theory that we hear come our way if enough people talk about it. And you have to understand, when mainstream companies like Fidelity or BlackRock or whomever decide they're going to get into the crypto space, they're only doing it because they see easy money to be made. They see a bunch of fools that they can trick into doing something and make a bunch of money off of them. Don't let them. Stop it. There are investments and then there are pure speculations. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
In addition to calling us on the show, sending in your questions at talkingrealmoney.com, we also want to help you in person. And that's why we make our advisors available to anyone who asks for free. Free, no obligation, no high-pressure sales pitch. Go to talkingrealmoney.com, click on Meet an Advisor.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?